Welcome to today's explainer. Okay, we've got to jump right in because we are looking at one of the most fascinating economic paradoxes in modern history. Right now, we're witnessing a booming, multi-trillion-dollar AI technology supercycle completely colliding head-on with some deep, unseen macroeconomic friction. It's literally a clash of unstoppable momentum meeting an immovable object. And we're going to unpack exactly how it's playing out. So, have you been feeling this contradiction lately? I mean, how on earth are markets soaring up to record highs, yet we're all feeling this massive, undeniable financial pinch? If you've been confused by this landscape, you're definitely not alone. It feels like we're living in two completely different realities. Today, we're going to bridge that gap and show you exactly where the money is moving. To make sense of the madness, here is our roadmap for today. We'll cover the unprecedented tech rally, look inside the AI stack, break down the 300 billion extraction, uncover the hidden consumer tax, check out some strategic sector anomalies, and wrap up with momentum versus friction. All right, Section 1, the unprecedented tech rally. Listen to this quote from legendary investor Stanley Druckenmiller talking about the 1999 tech boom. He said, I had to play. I couldn't help myself. I bought $6 billion worth of tech stocks. And what's wild is he ended up losing $3 billion on that single play. It perfectly captures this institutional FOMO, the fear of missing out that is totally dominating Wall Street right now in 2026. This isn't just retail investors pumping stocks. These are seasoned professionals who are terrified of missing their benchmarks. The career risk of not owning these massive tech companies right now is forcing immense, concentrated institutional buying, and it's creating a massive upswing loop. And all that forced buying, well, it leads to astonishing numbers. We're talking a 19% gain. That means the S&P 500 just hit its longest 9-week winning streak in 75 years. Actually, think about that for a second. The index has hit its 23rd record close this year alone. It's a historic surge. But, and this is a huge but, it is not evenly distributed. We are literally looking at a tale of two markets. Just look at this contrast. Information technology is up 2.5% recently, completely diverging from traditional safe haven sectors like utilities, which are down 3.1%. This early sign of divergence tells us that capital isn't rising like a tide lifting all boats. It's flowing in a highly concentrated, very specific direction. And here's just how extreme that concentration has actually gotten. Just 12 tech companies drove the vast majority of the index's recent returns. To put that into perspective, the top 10 S&P stocks are all tech-related, and they now make up an incredible 40% of the total index weight. If these top leaders begin to consolidate or pull back, the broader market is incredibly vulnerable because it is standing on such a narrow foundation. Moving on to Section 2, inside the AI stack. To really wrap our heads around this, we need to break the AI ecosystem down into 4 foundational steps. We start with the foundational models at the top, supported by the hyperscalers, powered by hardware and compute, and finally, all connected up by networking and servers. So who actually owns these layers? Well, in the foundational models layer, you've got players like Anthropic and OpenAI riding massive first-mover advantages. Then the hyperscalers, think Alphabet and Microsoft. They have these structural moats built on basically infinite capital and massive internal cash flow. Down in the physical hardware, companies like TSMC, Nvidia, and ARM operate as literal physical monopolies. And lastly, the connective infrastructure from folks like Marvell and HPE. These aren't just businesses anymore. They are deeply entrenched toll booths for the future of the global digital economy. But notice the foundational layer holding this whole shebang together. It's TSMC. They are essentially the single point of failure here. We talk a lot about cloud computing and AI, but it all relies on highly constrained physical stuff. Nvidia GPUs and ARM CPUs crunch the data. Marvell's optical transceivers act as the connective tissue, turning electrical signals into light, and it's all sitting in servers by HPE or Dell. But TSMC? They're the manufacturing bottleneck, physically printing the chips for absolutely everyone else in this ecosystem. All right, Section 3, the $300 billion extraction. Right now, the titans of the AI and tech world are issuing what is essentially a massive capital call to the public markets. Check this out. Alphabet is targeting an $80 billion raise just to fund unprecedented capital expenditures, or CapEx. Anthropic is eyeing a $50 to $60 billion valuation. OpenAI has a looming IPO. And SpaceX is prepping for an imminent debut at a historic $2 trillion valuation. $2 trillion. all of these massive raises combine into a giant liquidity sink. To fund this crazy infrastructure build-out required for 2026 and 2027, the market basically has to absorb upwards of $300 billion in new capital needs. This is an extraction. That cash has to come from somewhere to fund this massive equity and debt issuance, meaning it's going to be drained right out of other areas of the market to feed this incredibly hungry AI engine. So that leaves us with a really critical question to consider. Can broader market liquidity actually support this massive $300 billion extraction without causing the entire 9-week tech rally to just collapse? This right here is the fulcrum point. It's where the euphoria of AI slams face first into the cold, hard reality of macroeconomics. Which brings us to Section 4, the hidden consumer tax. First, let's just neutrally assess the global board. We're seeing mounting geopolitical flashpoints popping up all over the map. The collapse of US and Iran peace talks, Russia cementing military footholds, and some really complex global trade tensions. Now, on paper, US corporate anxiety is being temporarily masked by a super strong US PMI, that's the Purchasing Managers Index, which just hit a 4-year high indicating manufacturing expansion. But make no mistake, these global frictions have very real, very immediate consequences on energy and global supply chains. And here is the exact cost of all that friction. A negative $750 impact per middle and lower income household. Now, this isn't some official government tax. It's the very real felt cost of global instability quietly draining the wallets of the everyday consumer. Here's how it plays out. The US consumer was supposed to get this massive $250 billion boost from 2026 tax refunds. But watch how fast it just disappears. Surging gasoline costs knocked out $90 billion. Diesel and supply chain issues, that's another $60 billion gone. Jet fuel costs took out $50 billion. By the time the dust settles, that positive boost was completely erased, leaving us with a net $100 billion silent drag on spending power. So, while the tech index is soaring, everyday consumers are quietly pulling back, simply because their disposable income completely vanished at the gas pump and the grocery store. Let's pivot to Section 5, Strategic Sector Anomalies. Outside of the AI bubble, we are seeing some bizarre, highly strategic capital movements. In hospitality, Barry Diller's group just offered a massive $12.4 billion buyout for MGM Resorts, signaling that legacy physical entertainment assets are actually severely undervalued right now compared to tech. Meanwhile, Berkshire Hathaway executed a huge $6.8 billion bet on home builders, showing deep conviction in a physical housing recovery. And over in healthcare, I found this staggering. Wall Street Journal exposes of massive Medicaid billing anomalies in autism clinics are revealing deep vulnerabilities in private health billing. It's fascinating. Capital is hunting for hard assets and exploiting systemic cracks entirely outside the big AI narrative. And finally, Section 6, Momentum versus Friction. So let's bring this all together. On one hand, the momentum is absolutely undeniably real. The structural growth and the physical build-out of the AI infrastructure show zero signs of slowing down, and they're backed by really strong corporate earnings. But on the other hand, the friction is incredibly heavy. We've got a massive $300 billion liquidity drain looming. We have a fragile, top-heavy market leadership where just 10 stocks are holding up the sky. And we have an exhausted consumer base quietly choking on a $100 billion geopolitical energy tax. Which leaves us with this final, thought-provoking question to close out our explainer today. As you look at your own strategies and how you understand the world right now, are you going to bet on the undeniable physical momentum of the AI supercycle, or are you prepared for the silent friction of an unpriced geopolitical drag? It's a really complex balancing act, and I highly encourage you to dig deeper into the sources we covered today to navigate this incredible paradox for yourself. Thank you so much for joining me, and as always, keep learning.